All right, well, it's 9 o'clock, so we'll go ahead and get started then. Good morning, everyone. Thanks for joining us today on March 2nd, 2020 for today's brew. I'm Danielle Zimbrick, Marketing and Sales Support for E4 Insurance Services, standing in today for Brendan and Dan. Today's fun facts are that it is Theodore Seuss Geisel's birthday. You may better know him, though, as Dr. Seuss. Although he passed away in 1991, he is truly an iconic author. In tribute to his birthday, today's national holiday is Read Across America Day. In our pop culture history, today marks the release of CD players in 1983. The original cost for a CD player was nearly $900, with CDs at $30 each. Today we are welcoming Jennifer White, Product Manager with Living Benefits at John Hancock. And Jennifer, what do you have for us today?
Thank you for having me today. My name is Jennifer White. I'm with John Hancock. I'm the Product Manager for our Living Benefits portfolio. I've spent over 20 years in the long-term care industry, so I'm really happy to talk to you guys today about a new take on long-term care reimbursement riders. And I think over the years I've always heard and even described them myself as reimbursement riders. You only get what's needed, right? You're only using what's needed to pay for costs. You're only depleting from the death benefit what's needed. But I want to maybe challenge you to start thinking of them in a different way, that you can actually get what's needed to fund an individualized plan for long-term care. So that's where we're going to go today with this presentation. So we can go to the next slide, Danielle. Okay, great, thanks. So it's always important to talk about why this whole need exists in the first place. So right now there's 44 million adults who are providing care to family members. And these people are twice as likely to say their health is poor compared to the general population. They identify things like emotional stress, anger and anxiety, escalated substance abuse, and they even have higher mortality rates. Now we know paying for long-term care is very expensive, and most cannot afford to pay for it out of pocket. So this is what's otherwise known as the informal caregiving crisis. We can go to the next slide. So it's important to understand that long-term care coverage, whether standalone insurance, riders on different life insurance policies, it was specifically designed to help pay for the types of care and services people need as they age, because nothing else will pay for it aside from personal income or personal assets. And so when there's a need for care, families are typically left with two choices. They can either pay for the care themselves or they can provide it themselves. But as we just talked about, paying for long-term care is very expensive, so oftentimes families have no choice but to take on this very labor-intensive care. And it's not without consequence. It's physically and emotionally draining, and as you can probably imagine, caregiving responsibilities are typically not split equally among family members, which creates a whole other set of consequences. So John Hancock reviews our rider as true long-term care coverage. So it's specifically designed to pay for the care and services that no other insurance will. And this means families are now in a place where they can bring in trained professionals, which reduces the need for the families to provide this very personal and physically demanding care that can last for years. You can go to the next slide. So the other way we view our long-term care rider is that it's really meant to protect retirement income, not provide retirement income. And I think oftentimes there's this disconnect with long-term care insurance, again, whatever form, is that, people look at it and think, I can get this benefit and do something else with it other than pay for care. But if you think about other types of insurance, think about health insurance or dental insurance, this is what gives people access to specialized care. So if you need to have a tooth extracted, and you have dental insurance, you would typically go to your dentist and they would do it with special tools in a sterile environment. You would not go to your neighbor's house and have them pull out your tooth with a set of pliers in their basement, right? So it's a disconnect. So think of long-term care insurance as something that is meant to give people access to specialized care, people who are specifically trained to deal with people who have ADL deficiencies or who have cognitive impairments. And I know you might have heard this in the field, that the benefit is not meant to go buy a Ferrari or go on a cruise. So it's important when you understand the subject of long-term care, just not how to pay for it, but the subject of long-term care, it might help, again, reiterate the fact that people need access to specialized services. So a colleague of mine, she shared her story with me this past year, and it was about her aunt and uncle. And the aunt had been providing care to the uncle for about 10 years. He had dementia. They had 2 children who lived across the country. And because of this man's illness, he had not showered or bathed in over a year. So extended family who were in the area would come over, try to help the wife get him into the shower, do day-to-day things, and he wouldn't do it. He was very belligerent, very angry, and it was all tied to his disease. His wife, the primary caregiver, ended up developing pancreatic cancer this year, and she was gone in 2 months. So the children are now in a situation of flying home, and they have to figure out what to do with Dad. And they found him a placement in a memory care facility. And they said, how are we going to get him there? He's so angry, he's so belligerent. Well, with coaching from the folks who work there, they were able to get him to the facility, got him in the front door, and within a matter of 24 hours, this man had taken a shower. And within a matter of days, he was socializing with other residents in the facility. So if you think about it, how would this whole situation have been different if they brought professionals in sooner? How would his quality of life have been different? And what would the impact have been on his treatment and the progression of his illness? And how would it have helped the wife if she could bring in somebody who was specifically trained in caring for somebody with dementia? So in theory, it sounds really great to say families can provide care, but the reality is there's a specific skill set that's needed, and not to mention families have their own families, careers, and lives to tend to. So again, it's important to understand long-term care to understand how these products actually solve problems. You can go to the next slide. Okay, so these are, I guess, the 5 pillars of John Hancock's long-term care rider. So the first one is, yes, it supports the intended purpose of long-term care coverage. This gives people access to funds that can bring in people who have a specific skill set to assist people with ADL deficiencies or cognitive impairments. Second, it really helps families at claim time because the way we pay is with a reimbursement. We can now put ourselves in a position through an assignment of benefits, which allows John Hancock to work directly with care providers to obtain bills and pay them. So I know people talk about reimbursement companies and products is that you have to collect receipts, you have to submit receipts. Well, the customer doesn't have to do that, but yes, we need to get the receipts in order to pay them. But even with an indemnity rider, families are going to have to pay the bill somewhere along the line, right? So we can actually take that and turn it over, or the customer can actually take that and turn it over to John Hancock. And of course, using a reimbursement rider, because we're only reimbursing for actual expenses, it's either going to lengthen the coverage period that the long-term care can cover, or it will leave more for beneficiaries. The fourth thing it does is it allows someone to purchase up to $50,000 per month based on their individual need or their individual plan for long-term care, and it's regardless of the per diem cap. So we'll talk a little bit more about that in the next few slides. And then lastly, at tax time, things are much simpler because we're reimbursing for qualified long-term care expenses. Therefore, the benefits received are income tax-free. We can go to the next slide. And so I think we missed one. Can we go back one? Oh, no, I must have deleted it. Sorry. Okay. So here's a sample right here where John Hancock can offer richer benefits for a lower premium. And again, this is taking our Protection UL policy with a 4% monthly acceleration percentage. And it's comparing it to another carrier's GUL with a chronic illness rider that's capped at the per diem limit. So as you can see, John Hancock has an advantage here with our lower premium, and we're offering almost twice as many benefits. And I'm using, these are still the 2019 tax numbers since we're within the 2019 tax year still. The per diem number is now up to 11.4, I believe. So as you can see, we have the ability to pay out $20,000 to this customer on an income tax-free basis, and we're doing it for a lower premium. We can go to the next slide. Okay, a couple things to know about the per diem limit is while it has generally increased over time, this is not guaranteed to happen. A couple years ago, there was something called the Tax Cuts and Jobs Act, and I don't know if anyone knows, I'm just going to briefly tell you what happened, is it created a new formula, it's a new indexing formula that's used to determine this tax-free limit. And if you follow this formula, it would actually have reduced the daily tax-free per diem number from $360 to $250. And that would have resulted in a much lower monthly benefit. So there was a manual adjustment that went into effect that allowed the per diem to increase another $10 per year. But we just don't know what's going to happen in the future. So right now the formula is still the same, and it would result in a much lower number, but there have been manual adjustments in the past 2 years, as well as for 2020. But you have to think about what would happen if the new formula is put into effect, and what would happen for these contracts that are capped at the per diem limit. What if those per diem limit is lowered? Would the carrier be able to pay out over and above the per diem limit? And if they do, now we've created a big tax consequence for customers because they have to track all of those excess benefit dollars to prove that they were spent on qualified long-term care in order for them to be received income tax-free. So there's no guarantee how this will change in the future, but there's no guarantee it'll be enough to cover long-term care costs. And we can go to the next slide. So the other thing to know is that there's a potential gap between the average historical increase in the per diem and the actual increase in long-term care costs. So what you're looking at here is according to Genworth's 2018 Cost of Care Survey. And this is assuming the per diem benefit amount of $11,100 for the 2019 tax year. And the light blue line is the historical average increase in the per diem amount, which is just under 3%. The gray line is nursing home care increasing at about 4%. And the dark blue line is assisted living facilities increasing at 6.5%. Home care is pretty much in line with the historical per diem increase, but it's not necessarily in line with the future per diem amount. So there's no guarantee the plan to cover the costs associated with long-term care will be sufficient to cover future needs. So by using a reimbursement rider, we allow customers to purchase a benefit that takes into account the actual cost of care, inflation, or even what it costs in their area. Keep in mind the per diem amount is nothing to do with what it actually costs. It's the same from Florida to Denver to New York City. It's the same amount. So you're not able to really have a specialized or an individualized funding plan. We can go to the next slide. And the other thing to think about is by using a reimbursement rider, we're really ensuring that the benefits are going to the person who's actually, and that care is actually being provided to them, right? So this was from a Forbes article that came out a couple of months ago. I think it was over in the summer of last year. And it was all about the what they're calling the crime of the 21st century is financial elder abuse. It identified the frequency of this crime and highlighted that it's often committed by family members or other trusted individuals who are caring for people with cognitive impairments, and that's who we're talking about today. Think about what happens if checks are just being sent out to people who are in need of long-term care services, and how could that be misused? Using a reimbursement rider really helps ensure that care is actually being provided to the person who needs it. And again, using that assignment of benefits where we can work with the provider directly can really help reduce the risk of money being misused. We can go to the next slide. Next slide? Yes. Is it worth paying more to potentially have an indemnity benefit that's going to be almost half that of a reimbursement? Or is it worth paying more to have an unknown maximum monthly benefit that's determined by the IRS and not your client's individual plan? Or is it worth paying more to have the ability to hire people who are not trained to safely assist people at a time when they're most vulnerable? Now, long-term care chronic illness riders, they can pay for your client's care in whatever product is you purchase or you sell them is going to help at a time of need. And obviously, if somebody does have a child who is actually willing to quit their job or lives at home with the parents and can provide round-the-clock care, buy an indemnity cash product all day long to let them get paid for it. But the reality is families have a hard enough time getting their loved ones to appointments, never mind providing round-the-clock care. So I hope this presentation helps you consider how a reimbursement rider can really help your clients get what's needed to fund their individualized plan for long-term care. So with that, I'll turn it back to you, Danielle. Thank you.
Thanks, Jennifer. Sorry about that. My phone disconnected, so I had to drop off for a minute. We can open the floor to questions. All participants are unmuted, so if you have anything for Jennifer, go ahead. Well, I think that's it then, Jennifer. Thank you very much for joining us today. Have a great week, everyone.
Thank you so much. Bye.